Okay, Chapter 5, Part 2. Let's start with accounting when the merchandiser makes a sale. So you can see they recorded it as the gross sale, or revenue, sometimes it'll be also known. Maybe you offered also some sales discounts to get them to pay you quicker. Maybe there were some customers bringing in some returns that you have to credit back, and then you total that up, you have net sales, and then understand the difference here. You have gross sales and then net sales. These adjectives are very, very specific, and you have to get used to that. Then you less out the cost of goods sold, and now we have a gross profit. So it's very specific how they follow this through. Okay, each sale has two parts for a merchandiser. You recognize the revenue, but then you got to recognize the cost of the merchandise also, because you are taking away your inventory. Not only are you receiving money, but you're shipping out your inventory. So it's a two-step process. And you'll notice here we have, for one sale, you will have two journal entries. One to record the sale. Here we have it on credit. Notice $2,400 in accounts receivable, and then $2,400 in revenue. And then you have to take away your inventory, and you charge that up to cost of goods sold. So you reduce your inventory, and you charge it to cost of goods sold. Again, just like you were offered a purchase discount, now you're offering a sales discount, maybe to your customers, to get them to pay you on a faster basis. Again, because you might want your cash on a quicker basis, A, to reduce risk, or to pay your bills. And so you're going to have the same thing, only now you're offering these terms of 210, net 60. So now, you notice, these numbers can change. There's nothing fixed here. This is all negotiated between the buyer and the seller. And here they're offering terms of net 60 days. And so you want to speed that up by 50 days here, you notice. And so again, the account was paid full within 60 days. There's no discount taken. If the account was paid in the 10-day period, and you offered them 2% discount, now you notice you got your cash less the account sales discount, and then you take away from the accounts receivable the whole 1,000. So again, you do have to track that for it to balance. Sales returns and allowances usually involve dissatisfied customer and the possibility of lost future sales. So you will take back maybe defective merchandise, maybe they don't like the color, fit, whatever. And so this is very common in the industry. And notice you're just bringing back your inventory and reducing your cost of goods sold. But notice you have two different components here also. You got to reduce your sales, and you got to add to your accounts receivable, and then and when you reduce sales, you don't take away from the gross sale. You track it as a sales return and an allowance. This will net out to a net sale reduction, but you don't take away from your gross sales. And now you have to count back that you're putting back that inventory, and you reduce your cost of goods sold. Oops, what happened there? Sales allowances, again, they're just tracking it here. Maybe here there was no reduction of inventory because they kept the merchandise, but you just simply deducted $100 from their bill. So there are different ways that this can be handled. So let's look at the merchandising cost flow from an accounting cycle. As you can see, this gets it becomes repetitive for every period. But again, you start with beginning inventory, you add up your net purchases from your supplier. Now you have a merchandise available for sale total. You then take away your cost of goods sold to have your inventory. This goes to your income statement, this goes to your balance sheet, and that inventory now becomes the new beginning inventory for the next period, and then it goes ahead and repeats itself. Typically this is done on a monthly basis. Adjusting entries. Again, merchandising using a perpetual inventory. Remember, perpetual is that the computer system is keeping track. You still, if you still use a perpetual inventory system, you still need to go out and physically count your inventory, because there could be discrepancies, and those discrepancies can be maybe employee theft, which is very common, maybe shoplifting, miscounting. There could be a variety of issues. And so you do need to go out at least once a year to do a physical count to keep track. And here you notice that they're adding that up to you're reducing your inventory, and you're adding that up to a cost of goods sold, because that loss you have to eat. And they said that $250 shrinkage. They don't know why. They don't know who stole it, or if it was stolen. It could have been a miscount. It could have been anything. But you do have to account for that in your cost of goods sold. Notice let's look at some of these closing entries. You have your gross sales, and you're moving it out to the income summary for the end of the period. Notice the December 31. And now you want to close out all the various other discounts that you're doing. What you're doing for closing entry is, remember, you're closing out your income statement so you can start the next period, i.e. the next year, at zero. And so you have a variety of expenses here that you're closing out for that period. And then you move everything over to the owner's capital account, and then you take away the withdrawals. So the only changes from the prior one is now we have more expense items that we're taking away. And now we have what's called a multi-step income statement. And so what we're showing here is, whereas before we had revenues minus expenses to net income, here we're showing your sales, a variety of discounts, calculating your cost of goods sold to a gross profit. This is gross profit off of your merchandise inventory. Now you have your operating expenses to get income from operations. Now your net income. So it's a two-step process for merchandising. And what it is you're adding calculation of this gross profit. Multi-step income. Again, here's like Walmart. They have sales, cost of goods sold. You notice they're showing net sales. This net sales is after their discounts that they had offered. Now they're doing their gross profit. Now their operating expenses, and they just simply said all selling, general, administrative expenses, and this is tracked very closely by industry analysts and so forth. Then you have your taxes, and then your net income. So it's going to get far more greater detail now. Whereas a single step for like a service company would be an example. We just have your revenue, and it can be different revenue items, or maybe sales or service or consulting. They have interest on revenue, gain of sale of building as an example. Then they net out. You notice there's no calculation of gross profit here. There is no calculation. Classified balance sheet. Again, a classified balance sheet is structured where you start with your most liquid assets, and then you go down and record it to your less liquid assets. And so we put merchandise inventory after accounts receivable, but above the other supplies and other ones. The reason why is accounts receivable, you've already sold this inventory, so it's more liquid. And then of course cash is at the top, because here you've collected on your accounts receivable. So it follows that merchandising cycle. I'm not going to go into the global view. So here's the key ratios known as the acid test ratio. Sometimes it's more known as the acid ratio. And here we're taking the quick assets over current liabilities. Whereas before the current ratio took the current assets, we're now only listing quick assets. So what is quick? Quick is the most liquid of your balance sheet. We're taking cash, short-term investments, and receivables. What is missing is inventory. We do not count the inventory in this quick asset because this is what can be converted to cash very quickly. Again, you do want to keep at least about a 1.0 or higher because that shows the ability to be able to pay your suppliers. Again, selling inventory could take time, so they still want to know that this ratio, which is more conservative than the current ratio, is still above 1. That your assets are still greater than your liabilities is what this is saying. Another important ratio is your gross margin ratio. So again, what is that gross margin? Gross margin is net sales minus the cost of goods sold over your net sales. So the gross margin is net sales minus cost of goods sold. And it's a percentage of the dollar sales available to cover expenses and provide a profit for the company. Again, it doesn't take away the operating expenses. We're only calculating the gross margin ratio. It is used extensively by analysts as well as creditors. Why do gross profits change? Because sometimes companies will sell with a lower markup, maybe to maintain more competitive pricing to the consumers. Increased competition can lower sales prices. So every time you give a discount or a sales, you're lowering your margin. So here we look at the gross profit rate. For instance, Walmart is doing 21% here, 21, whereas Target is charging more. So what they're saying is they're making a greater profit margin. That means they're charging the customer more. The average for the industry is 25%. So you can see Walmart is offering very, very cheap pricing. Hence, they probably make a lot more sales per square foot, which is another ratio that is tracked. Here are some comparative examples of certain things that industries track. They do test the asset test ratio. Notice the current ratio. Notice that this will always be larger than the asset test ratio because they're adding the inventory, which increases the size of your current assets. And then they do track your gross margins. And you can see that this trend will be tracked very carefully by analysts. That's it for this system. For this part, I'll start with Chapter 6 at a later date. Thank you.